today, the art of building a high-quality property portfolio. Hello again, it's Martin North from Digital Finance Analytics, one of those posts covering finance and property news. Today, I'm joined by Aaron Christie-David from Atelier Wealth. Hello there, good to see you.
G'day, how you doing, Martin?
Yeah, pretty good. And thanks for coming on DFA. We had a conversation on your channel a few months ago when I was in Australia, but I'm now over here. But it would be good to get you just to introduce yourself and what your business is, and then we'll go into a bit more detail, particularly perhaps around mortgages and housing and all those good things.
Perfect. Yep. So as mentioned, I run a mortgage broking business called Atelier Wealth. We specialize in property investors looking to scale up their portfolios, predominantly focus on residential lending. We do some commercial as well. And our goal really is to help Australians build a high quality property portfolio that can ultimately build intergenerational wealth. Now, that may sound a little bit lofty, but what that means is making good quality property decisions that your children can be effectively the beneficiaries of in the future, but also give you a comfortable retirement in the long term as well. And yeah, you're fortunate to jump on my podcast, the Australian Property Investment Podcast. And again, just another resource that, we get you and other experts to come on to really share some knowledge and some insights. And, that's again, fundamental to what you and I are trying to do, which is good quality information, helping more investors, become confident in their own skin as well.
Yeah, and I think a couple of really important observations, and probably even more today, it's really important to make good decisions about property purchases. And, it's not a simple path in the current environment with high interest rates, with some property prices rising, some falling. So when you talk about good quality, what do you mean by good quality property?
Yeah, I think the big one here is not quantity. So I guess a lot of the information is how to scale up your portfolio, for example, and that can often mean buying low caliber properties. So cheap is another code word for it. So how do we avoid buying cheap properties? Buy better quality properties that have upside, whether that's through a good cosmetic renovation. You've bought in an up and coming area, so you're on that cusp of a market starting to accelerate as well. Or perhaps it's got some X factor, at some point in the long term, can it be subdivided? Is it in some type of infrastructure corridor, for example? And that's where we're looking for that little X factor. Can you take it from a 3-bedder to a 4-bedder, 2-bath, for example, a real sweet spot there as well? Do we know about, some future infrastructure projects that are coming up there that you can get in nice and early as well? And I think the common mistake that we're seeing is people buy the property and then reverse engineer their strategy, whereas what we're trying to be is a strategy first type of way of thinking, which means you build your team, get the strategy, and then we execute, as opposed to buying properties and trying to figure out why you bought them or what was the reason for them being part of your portfolio.
Yeah, and it's a really important observation there, because so often what I see, and I had lots of conversations with individuals who have been in the property game, and in some cases they just sort of jumped in because, well, everybody else was doing it. So, obviously you should buy property. And then the assumption is the property values always double every 7 or 10 years or whatever it is. And and I know that there are some properties that have done really well in recent times, but there are other areas, for example, high-rise units inside North Ryde is one I keep coming back to because they've gone nowhere for a long period of time. So you need to pick the location, the type of property, and all of those other things. In other words, you have to go granular. And sometimes what I see is that people have not done the homework. So they sort of assume almost magically that if you buy property, you're always going to win. And unfortunately, particularly now, that is just not true.
Yeah, and this market's really kind of set, it's, I guess, sorting out who bought well, during COVID, especially the last few years, and from my own podcast that I've got people coming on and they're talking about people selling, obviously 13 rate rises here in Australia, the people that can hold on and afford to hold on versus the people that bought at the peak and now are struggling. And there's a small subsegment of borrowers that are highly leveraged, that are choosing to sell, and it's then ultimately what's their sale price. And it's far too early, we know, from an investor perspective, it's far too early to cash out anything less than that 7 or 10-year mark as well. And there's another stat that gets thrown around that a lot of investors won't get past the 5-year mark. And the question is, why don't they?
Yeah. No, that's a good question. And of course, the recent CoreLogic Pain and Gain started to highlight that in some areas, people are actually selling quite quickly, simply because they bought the wrong property. And you know, and I know that the transaction costs of buying into property, are huge. So if you make the wrong purchase decision and then have to escape quite early, not only might you take a capital loss, but you've also got these other costs that you've spent and not recovered too. And I don't know what you see, but when I see property investors, quite often they haven't really done the maths at all in terms of thinking about what the returns could be.
Yeah, correct. And that's your real tangible factors there. The intangible ones then become a detractor around investment property. So that doesn't work. So I'm going to go chase crypto or shares, for example. And then the other one is, especially if they've got children, it's sending a very strong message that investing in property doesn't work because we got burnt by it. And I think that's where it does a disservice to a lot of other investors because they haven't, been diligent enough. It then, that knock-on effect, and it's like a bad complaint. Tell 10 people. And I feel like that's the intangible side on top of what you said there was just the financial side as well.
Yeah, that's a very good point. It isn't just purely mathematics. There's other questions to think about. Now, when it comes to some of the financial aspects of investment property, most people will probably leverage up and will be looking for, a mortgage to help the journey. What's your perspective in terms of the bank's willingness to lend at the moment? And is there more or less competition for a new business? How are you seeing it?
Yeah, there's two parts. There's no way to sugarcoat the fact that borrowing capacities have fallen. If we look on average, they're looking to drop from 30% from where they were before the rate rises to where they are now. So definitely there's a reality check when it comes to when people talk about their loans are hard to get. They're not harder to get. It just means you can borrow less. So there's a real distinction between the two. There is more in the way of mortgage competition, for example. So we saw the refinance rebates. They got done away with a few months ago. So the lender competition to try and steal business from other lenders by paying for a refinance rebate, that ship has kind of sailed. So they're just trying to win new business, so new loans, for example. We're not seeing the rate. So, lenders offering really attractive rates. But I guess where they're really trying to push is the service proposition, for example, is also that speed. Turning around decisions is improving as well. But everything that I've read around, what the bank strategies are for next year in the mortgage, in their mortgage game, is they know it's going to be intensely competitive because people may necessarily not be able to refinance due to those buffers that are in place and the inability to service on a refinance. And then the next one is there's a holding pattern, so holding, waiting and seeing for a lot of borrowers at the moment. So when are they going to pull the trigger and turn those pre-approvals into full purchases as well? So yeah, I think next year is going to be a very interesting time for the mortgage market. But having said that, everything we're seeing is still pointing to a fairly good 2024 as well. I'm sure some of the points we'll discuss in time. But yeah, everything that we're reading is the people that are going to get into the market in 2024 will become beneficiaries that, in 2025 and beyond.
Well, of course, the question is, how long will interest rates stay high? At what point will they begin to slide? And, most people, I think, are probably expecting it'll be late 2024 at the earliest before we see any significant relief in terms of interest rates. But as you go forward, you would expect rates to come down a little. We've also got very strong migration. And as a result of all those, dimensions, there's a lot of demand for property, a lot of demand for appropriate rental property. So you'd have thought that some of the positioning and parameters are there for significant opportunity later. But it is, I think, worth underscoring again, we should be thinking here a 5 or 10 plus year strategy rather than 18-month or a 2-year strategy. And unfortunately, many people seem to me to go in with a short-term expectation, which is just unrealistic.
Correct. I mean, this is it. We've got the bank factors in rate rises as part of the assessment rate, for example. So they've done a little bit of stress testing. That's one. But exactly to your point, which is, we get a few rate rises. That could be a blip in a 10-year play. And we'll get to the point that when rates come down, the market will then get that next wind, for example. So if you're going to wait for that time, you're going to be then competing on price versus if you can come in early now, especially if you're looking to purchase, then you might be able to get in before that next surge of interest starts to come in, because we know as there's talks of rate cuts, consumer confidence will then start to pick up. For example, the consumer confidence then leads to more, boots on the ground when it comes to open homes. That then leads to more intense competition for prices, and that cascading effect will then have that flow on for higher prices being pushed up as well. But having said that, when you look at the 2023 calendar year capital growth, most cities have done fairly well, considering we've had 13 rate rises, and I think most people are a little bit perplexed, going 13 rate rises. I thought property prices would have dropped. That's my opportunity to come back into the market, but it just hasn't played out that way as well. We had the fixed rate cliff, which was dubbed the next big thing, and we did research around that, and again, that was a blip. So I'm like, if we've COVID, we've done pretty well. Fixed rate cliff, we've come out of that fairly well. It just points to some cities being quite strong, and you overlay that with the migration and especially into the capital cities, it then becomes intensely competitive for people in those metro areas as well.
Yes, and I've had to update my models to take account of that very strong migration, which is I think it's worth just reflecting on the fact that 500,000 people in the country over the last 12 months that weren't there before is going to definitely help to support. And plus, of course, you've got very low listings at the moment. So one of the observations is that the quantity and the quality of property that's available to purchase at the moment is perhaps less flash than it might have been. And certainly we're seeing some listings being pulled at the moment as we come into the Christmas New Year period. So it'll be interesting to see what the first quarter next year evolves to in terms of listings. And I guess the broader questions are: will migration continue to go high, or will they dial it back? Will interest rates come down? And it's interesting, if you look at the latest from again CoreLogic, they're showing a slight reduction in momentum in Melbourne, particularly with values now perhaps going down, whereas in fact in some other areas there's still significant growth. So again, you can't just average the country, you have to go quite granular. And I also look at regional areas versus closer into the city, and again there are different dynamics going on there. So there's a bit of homework to be done if you're actually thinking of transacting in the market, I think. And I don't know what your perspective is, but I think the easy times are probably over. But it doesn't mean that property is still not worth considering, but you need to do your homework.
Yeah, correct. I mean, it's an easy market means everyone does well because it's a rising tide will lift all ships. So it's these type of markets that then separate. And you're right, listings towards the tail end of the year starting to drop off. But that doesn't mean, if you're a home buyer, you switch off. It means that you double down and you go, when everyone else is taking a break, this is your chance to really kind of put yourself on the map. So that's a mindset thing as well. You mentioned there around the regional areas, and I mean you're very familiar with the Illawarra as well. There was a great article that came out yesterday saying that on a dollar for dollar basis, Illawarra is now becoming more unaffordable for locals than Sydney.
Yep.
And that just blew me away, because obviously I call the Illawarra home as well, and which I think I've even struggled to get my head around that, because it was dubbed a fairly affordable corridor. But when you look at the time to save for a deposit on the median incomes, when you look at how much net income then goes towards servicing the average mortgage as well, it starts to actually get scary for a lot of potential home buyers. So what could be and what should be an attractive corridor for younger families that are trying to get their foot into the property market, first homeowners or even upgraders as well. The Illawarra was a magical corridor, but that again is kind of slipping out of grasp for a lot of families. So you're kind of scratching your head, going, well, where do you go? Do you keep going further south? And as you keep going, say further south, you're probably seeing some price drops out towards Shoalhaven, Bateman's Bay, for example. But then the question then becomes, what are the job prospects like as well, particularly if you don't have the luxury of a work from home and you need to be, as more returning to the city, like I'm in Sydney today, and the city's pumping, and you can see the return to work vibe is very much on. So, if you look at the Central Coast, I dare say the Central Coast has almost got a very similar effect to the Illawarra. And then I think we've seen a lot of Sydney-siders look at Newcastle as probably that next move. But then we're talking about, 2 and a bit hours north, and that becomes your hub effectively. So you're moving out of Sydney and moving into a different region altogether. You'd see the same thing in Queensland. Brisbane is doing some incredible numbers at the moment. Sunshine Coast is a bit like the Illawarra in that sense that it's becoming a premium price tag. The Gold Coast has done that. So where are those home buyers that are looking to break out of renting, moving into as well? And I guess the message here is waiting and hoping for the market to fall just hasn't happened. You buy what you can when you can as best quality asset as you possibly can purchase. And if you're renting, then consider a mortgage a bit like a forced savings as well. And I've listened to a really good podcast the other day with Mark Boris and talking about, a mortgage is a bit like an asset at the moment. Over time, it's becoming harder to get. It's been easier in the past. So we've kind of always been thought the idea of a mortgage is, bad debt, it's big personal loan debt, and that's cool. But a mortgage actually in today's currency can be an asset as well.
Yeah, well, I've never said that you should never get a mortgage. I think, I got mortgages through my life, but you have to pick the right property. And just by going back to the Illawarra, interestingly, of course, Austinmere went up 35% in 18 months post-COVID or through COVID. And that was because people were coming out and wanting to live in areas, with lower populations. So that was an amazing rise. Not surprised then that prices have slid back down since then. And I'm afraid affordability in many regional areas is now pretty much shot because, of course, the cost of living are hitting everybody, and travel costs are also higher as well. So it really does show you that dynamics can change, and areas that were attractive become less attractive, and that's just the nature of the markets. And I guess that's an important lesson. It's not a single linear story when it comes to property, but there are still opportunities, and there are still places where it's worth doing the homework and looking quite hard. I guess the other question here is with the reduction in new construction and new home starts too, it's going to be quite difficult to buy off the plan. And I know there were quite a few investors who were buying off the plan. My analysis of recent years is some of that off the plan purchase strategies really didn't work very well. So maybe buying an older property that's already been there and it's available immediately may make more sense than actually buying into the off the plan story. What do you think?
Yeah, I mean, off the plans have always had this stigma attached to it as well, and rightly so, because you're buying today and you don't know when that property is going to be completed, nor do you know what the market's going to look like in the future. Now, if you're a home owner buying in, again, the other challenge is you don't know where your lifestyle is going to be in, say, 2 or 3 years' time. And I personally, Bernadette and I will put our hand up. We bought a property off the plan thinking that we may move into it at some point, and then found out we were pregnant and we didn't want to live in Sydney anymore. And so that property was not going to service. And then investors are typically buying into these as well, 1 or 2 bedroom units off the plan, purely for depreciation. Then you've got this whole rental. And now, again, we talk about, perfect storm. Rentals at the moment are doing very well. So again, it's one positive to take out of that. But having said that, what we're looking for is capital growth as well as an investor. And is that property the right option or the right asset to give you the capital growth metrics that you're looking for? So again, case by case basis. But I feel like with the market, and we just don't know where it's going to land when your property is due for completion, that's the risk that you've got to really be willing to run. And I can only call an anecdotal advice, for example, that when someone has another baby or job changes, for example, and now they're due to settle on that property that's off the plan, there are some elements of their lifestyle that are out of control that then cause a little bit more stress or friction when you get towards that settlement off the plan. And I think that's the part. Yes, you've got purely the financial side when you're looking at it. Then you've got the lifestyles, which is, can you actually settle on this with minimal stress as well? And that probably where it gets a little people hot under the collar when it comes to settlement.
No, spot on. And of course, the other thing is you've got some uncertainty about the ability of builders to be able to complete. And, we've got high levels of building failures among building firms at the moment, which is another factor that people didn't actually think about early on. And I've unfortunately spoken to a number of people in recent times who've got this half-finished building. The building contractor has actually fallen over, and they're now trying to sort of scrabble around, trying to find somebody else to complete. And they're suddenly finding that it's a lot more costly than they expected it. So I think there are some reasons to be cautious about off the plan at the moment for all those reasons. But there isn't a lot of stock, so it's hard to sort of know which way to jump. Which means it's really important to keep your finger on the market in the areas that you're interested in, and make sure that you get first dibs with stuff as it comes on. And again, I was talking to an agent the other day who's saying, look, I've got quite a few new properties coming to list in January, because January is often a time when listings are up a bit. But he said, I've also got a lot of people looking. So there's still a lot of appetite, despite the fact that there isn't a lot of supply at the moment, which again suggests that there could be some underpinnings in terms of prices as we go into next year. So from a investment portfolio perspective, you earlier on said a small number of high quality properties rather than a lot of cheap properties. I just want to come back to that, because I think that's a really, really important observation. What I find when I speak with property investors who've been in the game for some time is that those who've actually made the good decisions on the way in are doing okay. But those who actually grabbed the cheap unit because it was actually cheap, and have a series of units, for example, in the same block, in the same property, are often the ones that are actually struggling. So I think building a portfolio of high quality assets over a long period of time is a really, really critical part of this game.
Yeah, it is. And again, I think it talks to where they're getting their advice from. So the DIY investor that bought a few properties a few years ago, rode the coattails of a fairly strong property market. It looked great. Until you could start to see some cracks in their portfolio, for example, and I've had the fortune of looking at a lot of investors' portfolios as a broker. I get to see the good, the incredible, and sometimes the mediocre or bad. And so when you're looking at the bad portfolios, you're analysing them, going, okay, so what were you doing? And imagine buying stock or shares just purely on price. Whereas other investors, when they're buying shares, are looking through that company going, is this company investable? Show me their financials, show me their future game plan, their vision. Am I buying into the board there, for example, and the management and what are their, what's their future growth plan looking like? And that's where you look at, Commonwealth Bank shares, for example, Macquarie Bank, and just continue to shoot the lights out as one example. And you can see it's a well-run organisation, for example, but very clear mandates around their growth and what they're looking to invest in from a project perspective. It's the same with high caliber properties. They're in a good location, and that's probably the first part, location and what can or can't be changed about a particular property, versus when people have bought cheap properties, and it's cheap for a reason. You're buying, poor builds, you're buying in poorer locations for an area, you're buying sloping blocks that you can't do much to it, you're buying houses with water issues that are very expensive to repair or maintain, you're buying in areas where there's no pride in the property, for example, so maintenance becomes an ongoing issue, or tenant turnover. So what we talk about a tight rental market, when you've got turnover, for example, that means a new property management fee each week. It means when a tenant comes in, they want things done or changed, versus having a consistent tenant in there time and time again. I've seen property prices, especially down our way, Martin, there's properties that rent for $1,200, $1,500 a week. So those are people that are on some fairly good incomes that want to be in a particular area. Maybe it's for work, maybe it's for kids' schools, for example, and they want that consistency. So don't think that you can, those top echelon areas are out of reach, because there's still a lot of properties that are on the rental market in those areas for people that are high caliber tenants as well. And so you don't need to keep buying cheap properties. And sometimes I feel like, they're sold this dream through a buyer's agent going, buy 10 properties and scale up your portfolio, but 10 at 350K each, I'd be buying, 3 or 4 at, 500 or 800K each, and then having less headaches, but higher quality properties as well. And naturally, sitting behind that, you need the borrowing capacity, you need the equity. But do you have to have 2 or 3 cheapies, or could you go for one high quality property as well? And again, it might be a slower way to build, but maybe the acquisition plans, one probably every 2 or 3 years, as opposed to 2 every year. And that rapid expansion just means, I see it leads to more problems when they're cheaper.
No, I tend to agree, and certainly I've seen a few people who've scaled up too quickly, got themselves in with too much debt, and then are forced to dispose of properties, and in some cases, significantly at a loss. Well, look, I've enjoyed catching up with you. It's been a really interesting conversation. If people want to find out more about you and what you do, where do they go?
Yeah, so check our website out, atelierwealth.com.au. And I mean, for anyone tuning in, I'm putting my book out next year called The Happy Home Loan Handbook. So that will be due on shelves in early March. And really the goal behind that is talking about home ownership. Now, we're talking about investing here. Home ownership is, kind of hitting 30-year lows at the moment. So I feel like if I could have this book out tomorrow, I would, because it's so topical at the moment. But the great Australian dream of getting into the market and owning your own home is dying a slow death. And I feel we've got to find a way to get more Australians to make confident property decisions when it comes to buying their own home and getting into the market. So that's kind of my mandate behind writing this book and having that ready for launch for next year. So if anyone's listening, jump online and stay tuned for when that book's going to be out.
Well, terrific. And I think you and I both share a common interest, which is helping people make better informed decisions, because, those are really big decisions that people take. And quite often, unfortunately, we see people making decisions on a rather narrow basis. And look, when the book is launched, send me an email. We'll make another show about it and help spread the word, because the more we can help people make better decisions, I think, everyone's a winner. Really appreciate your time today. Thank you so much for sharing your thoughts with me.
Thank you.
Okay. Take care. See you soon. Bye-bye.
Bye.